we're already actually starting to see it. We had the Market Composite Manufacturing Services survey out this morning, and that they commented that growth has slowed to the slowest pace so far of 2018. So we're definitely starting to see, as well as in the earnings season, a little bit of this fallout. And that's on top of the fact that critical industries such as automobiles and housing, we had another disappointing report out this morning. That's one of Fed policymakers' main concerns that was voiced in yesterday's minutes. But we've got housing down at a February 2016 low right now. So it's not going to take too much to tip this economy. But to Esther George's point, we've still got an economy that in some senses is roaring. Initial jobless claims remain at a 49-year low, and that means that the Fed should continue on its rate hiking path, which she'd said earlier on in that interview with Steve.
So, Katie, let's agree with what Danielle said, that we're already beginning to see some of the slowing here. How many tenths of a percentage point does a trade war shave off of an economy that's growing at nearly 4% right now?
Well, it could shave as much as 100 basis points off our growth rate.
Or a full percentage point.
Tyler, but
Cut it by 25%. Cut growth.
But I do think it's important to distinguish between the economy and stocks. And I do think that the impact on the stock market could be even more acute than perhaps on the U.S. economy, both the direct and indirect impacts on companies. We know that we have an S&P 500 that gets over 40% of their revenue from overseas. So the direct impact of a trade war with China would be
and yet
impactful.
You've kept your allocations very strongly in U.S. stocks.
We have, Tyler, and our perspective is that at the end of the day, there'll be an agreement. There's sort of a mutual destruction element to this escalation of a trade war with China. There's just a bit too much to lose on both sides.
That's a nice thought, isn't it?
We think that cooler heads will prevail at the end of the day, and there will be some kind of an agreement on the most important points, which clearly are around technology and intellectual property.
Danielle, at this point, what do you think? Do you think that the odds of a rate hike in December have gone down, given what we heard from the minutes and given what you said in terms of the recent data we've gotten?
They have slipped a little bit since prior to the minutes release, but by the same token, they've also risen for a January rate hike. So, I think that the disparity that we're going to see come out at Jackson Hole is that people like Esther George, as she said this morning, and Jay Powell, they would really prefer that the neutral rate be 3%. I think the dovish enclave there in Jackson Hole would prefer that it be closer to 2% and that September potentially be the last hike of this cycle. But again, if the unemployment rate keeps dropping, I do not foresee Jay Powell as stepping back in December and or possibly in January, because we're still a far ways away from 3%.